Welcome to Talk Tickers, your go-to for cutting through the noise of earnings calls and getting right to what matters. Today we're embarking on a deep dive into the second quarter fiscal year 2026 results for Signet Jewelers. They're the world's largest retailer of diamond jewelry. We've got the numbers, the strategies, the market context, and we're here to distill it all down into the crucial insights you need.
That's right. Signet's latest earnings call, it offered a really fascinating look, actually. You see how a market leader in, discretionary retail is navigating both a major strategic transformation and a very dynamic economic environment. So we're going to unpack their financial wins, delve deep into their grow brand love strategy, and then explore some pretty significant external factors, particularly these global tariffs that are shaping their outlook. This is a company with a clear vision, and their recent performance provides some really intriguing insights for anyone tracking retail or just broader consumer spending trends. So let's get into it.
Absolutely. Let's start with the headline numbers because they tell a compelling story right out of the gate. Signet reported a strong Q2, comfortably exceeding analyst expectations on both adjusted EPS and revenue.
Yeah, they did.
What really stood out to me was their delivery of positive same-store sales growth. That's, as we know, a critical health indicator for any retailer. And they've actually maintained this positive momentum for 8 consecutive months through August.
And the market certainly took notice. The stock closed up a solid 2.7% on significantly higher volume than its 3-month average. It kind of consolidated some earlier pre-market gains.
Okay.
So this signals a positive, albeit measured, reception to the company's performance and, crucially, their forward guidance. It tells us that despite a challenging macro backdrop, investors see Signet executing well and, managing expectations pretty effectively.
Okay, let's unpack this further then. Diving deeper into these financials, what exactly drove these beats? It wasn't just hitting targets, right? It was surpassing them.
What's truly fascinating here is the comprehensive strength behind those numbers. It wasn't just one lucky break, Adjusted diluted EPS came in at a $1.61. That significantly beat the consensus of $9.24 by about 30%.
Wow, 30%.
Yeah, that's a huge margin of outperformance. Revenue hit $1.535 billion, surpassing expectations by roughly $35 million, which is a 3.0% year-over-year increase.
Okay.
And as you mentioned, same-store sales grew by a solid 2.0%. But beyond the top line, the company also saw its gross margin expand by 60 basis points. That's 0.6 percentage points year over year to 38.6%.
Right.
This margin expansion, coupled with the revenue growth, led to more than 20% growth in adjusted operating income, which reached $85.4 million. The key insight here, I think, is that this indicates both robust top-line growth and incredibly efficient operations. That's a powerful combination in any environment.
That is a really impressive display of operational efficiency.
Yeah.
So with that kind of performance, how is Signet balancing reinvestment in these growth strategies with returning capital to shareholders? What's their approach there?
That's an excellent question, and it really speaks to their capital allocation strategy. They're doing both. Signet repurchased $32 million in shares during Q2. That brings their year-to-date buybacks to a substantial $150 million, and they still have $570 million remaining authorization.
Okay, it's substantial.
And they also declared a quarterly dividend of $0.32 for Q3 FY26. So this dual approach, investing in their future while consistently returning value to shareholders, it sends a clear message about management's confidence and their commitment to long-term value creation.
Now, you mentioned their grow brand love strategy. This sounds like it's absolutely central to their success. Can you break down how this strategy is specifically translating into these impressive numbers we're seeing?
Absolutely. This strategy is clearly their core driver. It's like the engine behind much of this performance. It's a three-pronged approach focusing on distinct merchandise, enhanced marketing, and unique customer experiences. And we're seeing it pay off significantly across their portfolio. Their 3 largest brands, Kay, Zales, and Jared, collectively achieved a strong 5% combined same-store sales growth. That's really noteworthy.
So let's dig into each of those prongs then, starting with merchandise. What's really resonating with customers?
Okay, on the merchandise front, they're not just selling, they're innovating. They're expanding collections like Unspoken and Shy Creation at Jared, introducing milestone gifting pieces at Kay, and building breadth in self-purchase fashion at Zales. But here's where it gets really interesting. A standout is the acceleration of lab-grown diamond, or LGD fashion.
Ah, yes.
This category now represents 14% of their total fashion sales. That's double what it was just last year.
Double, wow.
Yeah, so this isn't just a new product, it's a category expansion that's clearly capturing consumer interest and adding significant value.
Doubling LGD fashion sales in a year is a huge leap. How are they getting the message out then? Connecting with customers, what's new in their marketing efforts?
Well, their marketing strategy has undergone a pretty significant transformation. They've shifted to what's called a full funnel approach. That means they're engaging customers at every stage of their buying journey, from initial awareness right through to final purchase. And this has resulted in a 40% increase in impressions, even with only a mid-single-digit increase in media spend. That's highly efficient use of their marketing budget.
Very efficient.
Social media channel buys are up over 20% year over year, now making up over a quarter of their total marketing spend, which tells you where the eyeballs are, right?
Right.
We're seeing really specific, high-impact campaigns. Jared's Love Highway with influencer Taylor Hill, for example, and Kay naming musician Teddy Swims as their chief love officer.
I saw that.
Yeah. That Teddy Swims campaign alone generated over 2 billion impressions. Just illustrates the power of these targeted, engaging partnerships. The key insight here, I think, is that Signet isn't just spending more on marketing. They're spending smarter, leveraging new channels and cultural connections to really amplify their message.
Those are some impressive engagement numbers. And finally, on customer experience, how are they evolving that to complement the merchandise and marketing?
Well, while it's still in the earlier stages of development across the board, Jared has seen the best year-on-year improvement in in-store sales conversion.
Right.
This is partly due to things like upgraded packaging and integrated campaign presentations that make the in-store experience feel more premium and cohesive with the marketing messages. It shows they're thinking holistically about the entire customer journey, from seeing an ad to receiving a beautifully packaged piece of jewelry.
That's significant.
Yeah.
Let's talk about average unit retail, AUR. We're seeing some big jumps there across the board. What's driving that?
Indeed, yeah. AUR increased by a strong 9% overall. Fashion was up a remarkable 12%, and bridal up 4%.
12% in fashion.
Exactly. But the key insight here isn't just simple price increases. It's a sophisticated strategy of premiumization and a favorable mix shift. In fashion, those LGD products we just discussed are absolutely key. They carry a more than 3 times higher AUR premium compared to traditional fashion pieces.
3 times, wow.
Yeah. Higher gold prices also contributed, certainly. For bridal, customers are actively trading up to higher carat weights, and there's been a stabilization, maybe even a modest rebound, in natural diamond prices, which helps too. So this strategic focus on premiumization, coupled with a refined promotional strategy, meaning, less discounting, fewer promotion days, is clearly paying off for their AUR. They're showing they can drive revenue by expertly guiding customers towards higher value products, effectively creating rather than just responding to demand.
So it sounds like Signet's core brands are really leveraging this premiumization trend effectively. But what about their digital pure plays, Blue Nile and James Allen? Are they seeing similar success, or is it a different story online?
That's a crucial distinction, yeah, because the online space has its own dynamics. Blue Nile is showing positive progress. It returned to positive comparable sales in July and saw a 25% increase in fashion revenue for Q2, despite some temporary marketing shifts. So that's a good turnaround.
Okay.
James Allen, however, continues to be more of a drag. It impacted total company comparable sales by 120 basis points, although this was a modest improvement from Q1. Signet is strategically evaluating James Allen's positioning. They're testing faster shipping and more finished jewelry, trying to think its optimal place in the portfolio. They also recognized a non-cash impairment charge, largely attributed to these digital brands. It kind of signals a proactive house cleaning effort, clearing the deck to better focus on their core brand strengths.
Right, refocusing.
Yeah, it's an acknowledgement that not all segments are performing equally and that strategic adjustments are necessary.
Okay, and to execute on this ambitious grow brand love strategy and navigate these macro headwinds, strong leadership is absolutely vital.
Yeah.
Were there any key updates on Signet's executive team?
Absolutely. Leadership is foundational to strategy execution, right? In August, they added key senior leadership, including Julie Yoakum as the new K and People's brand president, and Lisa Leach as the new chief marketing officer.
Yeah.
These are strategic appointments directly supporting their brand-focused initiatives. They're also actively interviewing for a new technology leader, which the CEO noted is the last critical piece to fill. This signals a commitment to bolstering their leadership bench in areas essential for both their retail and digital transformations.
Makes sense. Looking forward then, how is Signet positioning itself for the critical holiday season, and what's the broader outlook they've provided?
Well, they've actually raised their full-year FY26 guidance. That reflects a clear confidence heading into the holiday season. Sales are now expected to be between $6.67 billion and $6.82 billion, which is up from prior guidance.
Okay, raise guidance.
Adjusted operating income was also raised to a range of $445 million to $515 million, and adjusted EPS to $8.04 to $9.57. Now, for Q3 FY26, they anticipate sales between $1.34 billion and $1.38 billion, with same-store sales ranging from minus 1.25% to plus 1.25%. That indicates maybe a bit of caution, but still a solid outlook given the broader economic environment.
This raised guidance sounds quite confident, especially heading into holiday. But on the flip side, the expected SG&A deleverage for Q3 seems like a potential red flag to some. How should listeners interpret that?
That's a very astute observation and an important question to ask. SG&A deleverage means, their selling, general, and administrative costs are projected to grow faster than their sales for Q3. If you just look at that number in isolation, it could seem concerning. However, management provided clear reasons, and it seems less a fundamental operational issue and more about strategic investment and timing. This is largely due to internal adjustments like resetting incentive compensation, some one-off change management costs from their ongoing restructuring, and critically, a strategic shift of some marketing spend from Q4 into Q3. They did something similar last year to avoid, premium media rates often seen post-election or during peak holiday. So while it's a deleverage, it's largely planned and in some ways an investment for a stronger holiday period.
Okay, that context is vital. We've also heard a lot about tariffs in the news, particularly concerning India. How is that impacting their guidance? What are the implications for Signet here?
This is a huge one. It's a significant swing factor for their profitability and a real-world example of geopolitical dynamics directly impacting a global retailer. India currently represents roughly half of Signet's finished merchandise purchases. Half.
Wow.
Yeah. And in the last 5 weeks of Q2, India's tariff on certain items increased dramatically from 10% all the way up to 50%. Now, this 50% tariff includes a 25% Russian trade penalty. This is crucial because while the diamonds might be processed in India, global sanctions mean any material originating from Russia, even if heavily processed elsewhere, can fall under these higher tariffs. It creates a significant geopolitical hurdle for Signet's supply chain.
Okay, so it's complicated.
Very. Signet is implementing various mitigation strategies, leveraging existing inventories, shifting some production to other countries, carefully evaluating pricing adjustments, utilizing bonded warehouses, trying to minimize the impact. Their guidance explicitly states that if the full 50% tariff remains in place, their adjusted operating income will likely land at the mid to lower end of their range.
Okay.
However, if that Russian trade penalty is removed within the next 2 months, they expect to reach the upper half. So this policy decision alone could significantly impact their profitability and is a key variable for the coming quarters.
That's an incredibly detailed look at a really complex issue. So, with all these factors in play, the strong internal execution, the strategic investments, the looming tariff questions, what does this all mean for the holiday season then?
Well, Signet is clearly preparing with a strategic and comprehensive approach. They're bolstering their LGD, men's, and other trending category assortments. They're especially focusing on the key $200, $500 gifting price points, which are crucial for holiday.
Right, that sweet spot.
Exactly. They expect LGD fashion inventory below $1,000 to be at least triple last year's levels. That highlights their aggressive push in this growth area. They are acutely aware of what they call a measured consumer environment for Q4, indicating a level of prudence while still pushing for strong sales through these new collections and refreshed marketing. They're attempting to control what they can, their product mix, marketing, customer experience, while navigating these unpredictable global complexities.
So for those of you following the retail sector, what's the bigger picture here? Why should you care about Signet's performance beyond just the headline numbers?
Yeah, if we connect this to the broader discretionary retail landscape, Signet's performance is truly noteworthy. They've actually outperformed the retail ETF XRT over both the 1-month and 3-month periods. That signals strong internal execution against broader sector trends.
Interesting.
Their capital allocation strategy, focusing on organic growth, maintaining a conservative balance sheet, consistently returning capital, it provides a stable framework. The disciplined inventory management, the strategic shift towards core brands, like that house cleaning effort on digital brands. These are all key signals that management is actively positioning the company for sustained success, even amidst significant external headwinds like these tariffs and a cautious consumer. This deep dive really shows a company trying to control what it can, innovate where it needs to, while effectively navigating global complexities. It's a good barometer, I think, for how agile a large retailer can be.
All right, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on today's deep dive.
Okay, love this part. Given Signet's Q2 performance and forward guidance, especially that strong acceleration in lab-grown diamond fashion and the explicit tariff contingency, here's a thought for your investment committee. A bit outrageous, maybe.
Lay it on us.
I propose a long position in Signet, SIG, paired with a short position in a pure-play natural diamond mining or distribution company. Or maybe an ETF heavily weighted towards traditional natural diamond producers.
Intriguing. Okay, pairs trade. What's the rationale?
Okay, the rationale is this. Signet's LGD fashion penetration has doubled year over year to 14% of fashion sales, driving significant average unit retail expansion. That's fact. Management clearly sees LGDs as category expansion, not cannibalization. They're attracting new customers with that 3 times higher AUR premium.
Right.
This strongly indicates a secular trend benefiting retailers who embrace LGDs and can integrate them profitably. Concurrently, that tariff inflation on India imports, including the 25% Russian trade penalty, highlights increasing geopolitical risks impacting traditional natural diamond supply chains. If that penalty gets removed, Signet's adjusted operating income guidance shifts to the upper half. That's a significant upside catalyst for the long side of this trade. So our thesis is that the market might be underappreciating Signet's agility and ability to leverage LGDs for margin-rich growth. While on the other side, traditional natural diamond producers may face increasing headwinds from both LGD adoption and these persistent supply chain and geopolitical risks.
Okay, makes sense.
This trade aims to capture the outperformance of a modern, agile jewelry retailer successfully adapting its mix versus the potential structural and geopolitical pressures on traditional diamond sourcing. The outrageous part. Well, it's a bold bet on the long-term category expanding power of LGDs, dramatically outpacing the perceived stability of traditional natural diamond values. And it's exacerbated by that near-term policy catalyst with the tariffs. It's basically betting on innovation over tradition in a market undergoing a quiet revolution.
What a deep dive into Signet Jewelers Q2 FY26. We covered their solid financial performance, the compelling grow brand love strategy that's clearly driving growth, and their proactive, yet definitely challenged approach to navigating this whole tariff environment.
Indeed. This company is clearly adapting, innovating, and executing in a complex landscape. And remember, everyone, this deep dive is for informational purposes only. It is absolutely not financial advice.
Right. As we wrap up, consider this. In a world where consumer sentiment is constantly shifting and product innovation is accelerating, how much value does a company create by actively shaping trends with new products like lab-grown diamonds versus relying solely on established traditions and supply chains? And what implications does that have for other discretionary retail sectors that might face similar kinds of disruptions? We'd love to hear your thoughts. Until next time.